Well, good afternoon, everyone, and welcome to our fifth webinar in our government CPE series. Today, we'll be presenting GASB 84 and GASB 87 Deep Dive. I'm Stacy Dreher, Marketing Director for James Moore & Company, and I'll be your host. So our presenters today are Anthony Walsh and Wayne Durrett, both of whom are CPAs and audit managers with our firm. Anthony has extensive experience serving government entities and higher education organizations, and as such, he serves as a key member of our government and our higher education services team. And Wayne has extensive experience serving government entities, higher education organizations, and nonprofit organizations, and he serves as a key member of our government services team. So with that said, I will turn the presentation over to you, Anthony, to get started.
Thanks, Stacy. So welcome everybody, glad you could join us today. Today we're going to discuss both GASB 84 and 87. With respect to GASB 84, we're going to discuss what the standard is, why the standard was created, and when it'll need to be implemented, fiduciary component units, fiduciary activities, determining what each of those are. And then there's some related pronouncements to GASB 84 that came out shortly thereafter that affect the implementation with respect to some pension type activities. Same deal for GASB 87, what the standard is, why, when we're going to need to implement it, the practical considerations of implementing it, and then we'll go through some of the details of the implementation guide 2019-3 that specifically deals with implementing the standard. And then following that, we'll have time for question and answer. So GASB 84 Fiduciary Activities, what it is, it's a standard that's going to require us to identify fiduciary activities of state and local government entities, and it's going to provide that criteria for us. The goal was to eliminate ambiguity that has existed in defining a fiduciary activity. Some of our entities on here that are of a higher ed nature will know that in the past they've shown some activities that may now be required to be shown in fiduciary statements as liabilities on their financial statements. And so that's some of that ambiguity that has existed, is just the application of what is or isn't fiduciary. And it's effective for periods beginning after December 15th, 2019. So that means your June 30, 2021 and June 30 or September 30, 2021 will be the key years that will need to implement that. So the scope, it provides criteria for three types of activities: fiduciary component units, pension and OPEB arrangements, and other fiduciary activities. And really what that means is we won't have the term agency fund anymore. They're going to call that custodial funds. Some of you may be aware, but that is some of that type of other fiduciary activities that you're used to presenting in fiduciary statements that will have a little bit more concrete criteria moving forward. Fiduciary component units, of course, we'll go through explaining those as well. So whether a component unit is a fiduciary component unit, so assets held by a component unit that meet one of these following criteria. So pension plans administered through a trust, OPEB plans administered through a trust, or any other assets that are not part of the reporting entity and are accumulated for pensions or OPEB. Pension and OPEB arrangements that don't meet that definition of a component unit are still fiduciary activities if the government controls the asset in an arrangement as described above. There are also going to be some component units that are held for the benefit of organizations or governments that are not part of the reporting entity and are not derived from the government providing goods and services to benefit recipients. So that is another instance where that could be a component unit, but that's not an OPEB type arrangement. So this flowchart, I think, is great in explaining how to determine if you have a fiduciary component unit. And throughout this presentation, you'll see a couple more that I think they're just a great illustration of the thought process of determining this. The standard, it can be a little wordy, for what at the end of the day can be sort of cut and dry. So here you see, you have to make the determination of if it's a pension or OPEB arrangement, making that determination. If it is, then does it fall under the applicable GASB 67 or 74? Therefore, if it does, it is a component unit, et cetera, as we've discussed, those type of activities being in that range, as well as moving through this flow chart of saying, okay, if it's not for that type of arrangement, is it an activity that is in a trust? Are those resources own source revenue, or are there services being provided to intended beneficiaries? So again, like I said, I think this flow chart is great for showing the decision tree of whether or not you have that fiduciary component unit to consider. So other fiduciary activities, they center on the control of the assets and beneficiaries with whom the relationship exists. They have to meet these criteria. It's not a one or, you have to meet them all. So assets controlled by the government. This can mean to not only holding those assets, but say you are investing those assets on behalf of another entity, that would be controlling it. That investment activity would be considered controlling it. So again, some of our higher education entities have had in the past where they hold funds on behalf of another entity for the purpose of investing it, and that does meet that criteria of both being held and directed. Assets are not derived from the government's own source revenues or from government mandated non-exchange transactions or voluntary non-exchange transactions. So the own source revenue piece can be important here. With higher ed entities, one question we got was whether or not athletic fees would be considered an own source revenue. In this case, it is considered an own source revenue, so you would not have to treat those as a fiduciary activity. Some other type of activities you might see, donations and that kind of thing, where those do fall under that voluntary non-exchange and would therefore not be considered fiduciary activities. Assets have to have one or more of the following criteria here. So they must be administered through a trust. If government is not a beneficiary, dedicated to providing the benefits in accordance with benefit terms and legally protected from the government's creditors. Or they must benefit an outside individual or entity, and the government does not have administrative or direct financial involvement with the assets. So going back to that investment analogy, in that case, they don't necessarily have the administrative or direct financial involvement with the assets, because they're segregating those assets for the purpose of providing the benefit to the beneficiary, but they are still meeting that criteria before, where they're holding and directing those assets. So the fact that they're not receiving the benefit from holding that, and they're just doing that as part of their goodwill with that other agency, that satisfies that criteria. So a key consideration here is control, and I've touched on that already. It has to be held by the government and directed by the government. And so that really does lean on, physically controlling those funds, both in where they're held and whether they're invested by the government or they're just held in accounts to then be dispersed at some point to the beneficiary. Own source revenues, again, exchange and non-exchange revenues generated by the government itself. So property, sales and income taxes, water and sewer revenues, investment income, athletic fees, like I mentioned already. I know when I worked for another institution at one point, we broke down the tuition bill into not just tuition, but also the various fees, a health services fee, a technology fee, et cetera. And so those would, again, be own source revenues. Administrative involvement, who's establishing the specific guidelines, the criteria for eligible expenditures, and how the resources may be spent. So again, here, if you're investing those assets on behalf of another entity, or you're holding revenues that, say in a tax collector situation where you're collecting taxes on behalf of another entity and you're then holding those to transfer on to that other entity, you don't have you're not setting the criteria for what an eligible expenditure is. It's either set by statute or through a gift agreement or something along those lines. And so that pretty much removes you from that administrative involvement, where if you did have the administrative involvement, that's a different consideration, and you'll see in an upcoming flow chart where that can direct you in another path as far as how to move forward. So again, as I mentioned, this flow chart directing you through the path of determining if it's a fiduciary activity. This is obviously not a component unit. It pretty quickly sorts out the pension arrangements and moves you to that component unit piece. Again, determining whether or not the government's held the asset, whether or not they can direct the use of the asset, whether it's for a pension or OPEB arrangement, the own source revenue. And then it gets into those pieces. Is this government mandated or voluntary non-exchange transaction, or is it a pass-through grant situation? If it's not that, is it part of a trust? If it's not that, are we providing goods and services to beneficiaries from these funds? If not, then are we benefiting an individual, which is a key factor there. If you are not benefiting an individual, in that case, as you follow this tree, it would not be a fiduciary activity. Where if you are, then it then depends on whether or not you have that administrative involvement with the assets. In essence, endowments, I think, and donations are a good thing to think of in that category, where sometimes you do have that administrative involvement with the assets, and that is removing that piece from being considered a fiduciary activity versus, say, the canteen fund for a sheriff's department, or something along those lines. So our first polling question, is a component unit of a university considered a separate government for purposes of GASB 84? And so our choices are yes, no, and phone a friend.
So we'll give everybody a few more seconds to answer this initial polling question. Okay, there's a few more coming in, so I'm going to close this out in just a minute here. All right. And let's share the results. So it looks like 39% said yes, it's the entity for whom the statements are being prepared. 41% said no, the government is the university, and 20% said phone a friend.
Well, I can tell you what I did when this question came up for me in real life, and I phoned a friend, and that friend was Gatsby. And they told me that, in fact, yes is the correct answer. The government is the entity for whom the statements are being prepared. So while the government is, of course, a university, a direct support organization or component unit of that university could be considered a separate government for purposes of GASB 84, depending on the legal structure of that entity, statutes in the state, et cetera. So as far as making it as general as we could here, yes, you would need to separately consider GASB 84 for some arrangements of activities between direct support organizations and the university, or direct support organizations and each other, as they would apply to their own financial statements and then to the financial statements of the university. So for financial statement presentation, there are 4 types of fiduciary funds that could be reported. There are pension and other employee benefit trust funds, which will follow their applicable standards, investment trust funds, private purpose trust funds, and custodial funds. And as I mentioned before, this is going to replace the terminology for agency funds, but for the most part, it's the same concept. Within that custodial fund bracket, there's actually one caveat in particular that I think is important to note. If there are external portions of investment pools that are not held in a trust, but they meet the criteria of paragraph 11C1 of the standard, which explains that investment trust activity, they should be reported in separate external investment pool fund columns under the custodial fund classification. So I can show you that a little more when we look at a sample statement where then you would want to split that out into a separate fund column to show that activity as required by the standard. There is going to be the requirement for a statement of changes in fiduciary net position. So before we just showed the balance sheet activity for the fiduciary funds, but now we're going to have to show the additions and deductions from these funds. And so that is a little different. However, there's an exception. If the funds that are held are dispersed in 3 months and are reported, they can then be reported in one line and deduction. So if you're collecting funds and remitting them in that 3-month timeline, if you're collecting funds on a continual basis and then remitting them to whatever entity, say you're collecting those taxes as a tax collector, but you're paying them back out in a month, there could be some gray area there where maybe that could be reported in that aggregated concept. But for the most part, we're going to see these being shown with additions and deductions split out. So again, here another flow chart that does explain how to determine if it's a fiduciary act or what type of fiduciary activity or component unit. These are all in the handout that we gave you, and I 100% recommend following them as you're going through your own decision-making process of how to report on your financial statements. I also recommend making notes near them to explain the decision-making process you made. So again, here, as you follow through, if you were to consider an activity that is not under statement 67 or statement 74, you then follow that tree through to determine if it's a custodial fund or if it then meets the definition of an investment trust fund. But again, under that custodial fund, certain investment assets would need to be shown separately. So the statement of changes in fiduciary net position, it's going to be the most common applicability impact. So for counties, tax collectors, and other agency custodial funds, they're likely going to need that additional schedule. School board internal accounts, the information may already be presented in the internal account report, but the format might need to change. So that might be one where you need to get with the accountants that you're working with to make sure that you're presenting that appropriately. You probably have the data you need to update that, but again, you may have to change that formatting. For institutions of higher education, luckily endowments shouldn't really be considered a fiduciary activity for this, so that part of your financial statement should remain the same. However, funds held on behalf of universities or other direct support organizations will likely require the additional reporting. So again, if you're holding assets to be invested on behalf of another organization or the university outside of a typical endowment arrangement where those funds are given to a foundation, that would likely need to be split out into fiduciary statements. The practical impact of all of this is that we're going to be capturing the additions and deductions in sort of revenue expense accounts versus relying on separate activity reports. There's change in the presentation terminology for all fiduciary funds. Liabilities will only be recorded when an event has occurred that compels the government to disperse fiduciary resources or a liability to those other than the beneficiary. So you'll carry a fund balance for these funds now instead of just having, an offsetting liability account, unless there are payables out of that account or other liabilities that just occur throughout the normal course of business. And so here are some samples of what the statements will end up looking like. They're a lot more detailed than, I would think 99% of these will get into having this many lines on them, or even maybe this many of the columns. We're trying to show out each type of activity. As you can see in the pension and OPEB column, it's following, GASB 67 and 74 presentation rules, investment trust, breaking out the classes of the assets they're holding. So not just showing, an investments line, but actually showing the types of investments that are held. Private purpose trust funds, again, doing the same thing. And then custodial funds here, which is going to affect most people. The important part to show here is, again, that individuals, organizations, and other governments restricted fund balance or net position. But this one does show liabilities to local governments and accounts payable out of those custodial funds. So it will be important to split out those liabilities as you're preparing these statements, and note that rather than having an assets held on behalf of others liability line, you'll now have that net position. As far as the statement of changes is concerned, it's very similar to what is prepared already for GASB 67 and 74. You're now just stretching that out into the other fiduciary activity types. One key note here is that the standard does require that the investment earnings be split out so that you show the fair market value increase, interest, dividends, etc., and then the cost of investment. So this custodial fund here just shows, sales tax collections and some miscellaneous collections within the payments out. But if you're holding other custodial funds, again, those investment type custodial funds that aren't a trust, but fall sort of in that halfway in between category, you would need to show those investment earnings split out from their investment cost when you're preparing these statements. So GASB 97 is related to GASB 84 in its effect of limiting the effects of Statement 32. So it's going to limit the applicability of financial burden criteria to exclude defined contribution and OPEB plans, and it will specifically exclude Section 457 plans. And this was because there was concern that the additional cost of reporting certain defined contribution plans as fiduciary trust funds would just exceed the benefit of any type of reporting in that situation. And so Statement 97 changes the criteria for including defined benefit plans as component units. It addresses the concern that those additional costs of reporting contain defined contribution plans as fiduciary trust funds would not exceed the expected benefit of reporting, and it's going to vary by topic. There are several different tiers of how this is applied, with the 457 effects being immediate. So if we go to the next slide. So GASB 84 amended component unit criteria by indicating that primary governments are considered to have a financial burden from a trusted pension or OPEB plan when the primary government is obligated to make contributions to those plans. The implementation guide provided that the absence of a governing board should be treated the same as the appointment of a voting majority of a governing board by that primary government if the primary government ends up performing those duties that the governing board would. Specifically for those 457 plans, the comprehensive implementation guide specified that pension standards should not be applied to benefits provided through those specific plans. So again, there were concerns about the structure of those plans and the goal of having those plans, and that this standard could have some negative cost effects on that. And so that was sort of the reasoning behind all of this. Certain component unit criteria is effective immediately, as I mentioned. So the absence of a governing board in determining financial accountability, except for component units that are defined contribution pension plans, defined contribution OPEB plans, or other employee benefit plans like 457s. If there is an absence of that board, you're going to treat that as if the primary government is the board or appoints the majority of that board. And the applicability of the financial burden criterion in paragraph 7 of Statement 84. So this is applicable only to defined benefit pension plans and OPEB plans that are administered through trusts and meet the criteria in paragraph 3 of Statement 67 and 74. So Section 457 plans, they should be classified and accounted for and reported either as a pension plan if it meets the definition of a pension plan, or an OPEB plan if it does not meet the definition of a pension plan. You'll apply 84 as amended to determine if the plan should be reported as fiduciary. Most are defined contribution, so they shouldn't be reported as component units, but again, there could be some gray area there depending on how that plan is structured. And it's effective for fiscal years beginning June 15, 2021. And so that is everything on GASB 84. If Wayne, you want to hop in now.
Yeah, absolutely. Thanks, Anthony. So like Anthony mentioned before, with GASB 87, we're going to touch over a high-level overview of Statement 87, but we're also going to go through some visual refreshers. We're actually going to walk through an example with T-charts and debits and credits for those of you who like to learn visually like myself. And then we're actually going to jump into the implementation guide and go over some specific questions. So jumping right into it, Statement 87, what is Statement 87? It requires the recognition of lease assets and liabilities for leases that were previously classified as operating leases. So why are we doing this? To better meet the informational needs of the financial statement users by improving accounting and financial reporting for leases by government. So maybe the most important thing you guys will learn here today, this is an improvement in financial reporting, and it's going to help the users of the financial statements. So when is it effective for? Periods beginning after June 15th, 2021. So just a high-level overview, what is it? It's a comprehensive change in the way we're going to account for leases, putting both what were previously known as operating and capital leases and related liabilities on the balance sheet. So what it's not the exact same as the FASB standard that some of you guys may be familiar with. The FASB standard is going to establish two different types of leases with financing and operating, but the GASB does not differentiate. Going forward, we're going to have one lease, and that's going to be accounted for under a single standard. So scope and approach, GASB 87 is going to be applied to any contract that meets the definition of a lease unless it's specifically excluded. We're going to talk about some of those exclusions later. The definition right here is going to be really important. It's something you guys should become very familiar with, if not memorize. As you'll see as we get into some of these questions, we're going to come right back to this definition of a lease. So the definition of a lease. A lease is a contract that conveys the control of the right to use another entity's non-financial asset as specified in the contract for a period of time in an exchange-like transaction. So breaking that down even a little bit further, the two big pieces here is you've got the contract that conveys the control of the right to use another entity's asset, and then down at the bottom you've got the exchange or exchange-like transaction. So if you don't have the control piece or the exchange piece, then you don't have a lease. So looking at the control piece just a little bit more, Stacy, if you wouldn't mind backing up just one more slide. Looking at that control piece just a little bit. So obtaining the present service capacity, I actually looked up on the GASB the specific definition for that, and what they mean by that is obtaining the use of the asset and its existing capability to enable the government to provide services. And then also looking at the determining the nature and manner of a use. Really the key here is, does the government have the ability to determine how the asset will be used during the period of the contract? So there's a little bit of nuance there that we'll talk about with some of our examples later on, but for now, we'll just keep it simple. Next slide, please. All right, looking at the lease term. So the lease term, once you've established that the contract meets the definition of a lease, it's going to include any non-cancelable periods of a lease, plus any periods covered by a lessee's option to renew if it's reasonably certain that the option will be exercised, any periods covered by a lessee's option to terminate if it's reasonably certain the options will not be exercised, and the same rules on the other side if it's a lessor. So we have that single party option to either renew or to terminate, as long as it's going to be reasonably certain that the option will or won't be exercised. Any fiscal funding cancellation clauses are going to be considered like other options to terminate. Down at the bottom, we're going to reassess when an option is exercised or not exercised, contrary to what the previous expectation was. So an example of this, let's say at the inception of a lease, it was reasonably certain that let's say the lessee was reasonably certain that the lessee's option to renew was going to be exercised. However, based on new information later on, for whatever reason, maybe let's say you went from a 90% certainty that it was going to be exercised. Well, now you're 49% sure that it will be exercised. So you're more likely that it won't be exercised. You're not actually going to remeasure the lease until an actual event has occurred, such as you've actually physically declined that option or some other event has taken place. So just because the expectation changes, you're not necessarily going to remeasure the lease at that time. All right, short-term leases. If the maximum possible term is less than 12 months, regardless of the likelihood, then it's going to be exempt from GASB 87. So I know probably a lot of you have thought about this already. Just keep in mind that regardless of the probability, if there is any possibility for options for extensions or renewals, then it would be subject to GASB 87. So for those of you that are planning to restructure all of your lease contracts to avoid GASB 87, make sure there's nothing in there as part of the agreement that mentions anything about any extensions beyond 12 months, regardless of likelihood. All right, sticking with proposed lessee reporting, or actually jumping into lessee reporting. Initial recognition and measurement, we're going to recognize an intangible asset for the right to use the underlying asset, and then a liability for the future payments. The asset is going to be amortized over time. So initial measurement of the lease liability is going to include any fixed payments to be made over the lease term, any variable payments based on an index or rate, any variable payments that are in substance fixed, any residual value guarantees if they're reasonably certain of being required, any purchase options if they're reasonably certain of being exercised, if there are any termination penalties, if the termination option was considered reasonably certain of being exercised at the time of the lease inception, any lease incentives, or discounting of the gross liability. So the liability does not include any lease payments that are dependent on a lessee's performance or usage of the underlying asset. So example of that you see it's pretty common is excess mileage on an auto lease. So any portion of a contract that's dependent on usage is going to be excluded from the lease liability itself. All right, so lease liability simplified, what this is supposed to represent is all of the money that's going to be paid over the term of the lease, discounted back into today's dollars. So think of it that way, it's a little bit simpler. Just think about all the money that's going to be paid out over the term of the lease and discount it. So that brings us to polling question number 2. Do easements meet the definition of a lease? We've got yes, of course they do. Maybe, it's definitely a possibility, and no, what are you, crazy?
Thanks, Wayne. We'll give everybody a couple more seconds here to respond to the poll. And again, if you're unable to answer the poll for whatever reason, don't hesitate to put your answer in the Q&A function and it will be recorded for your CPE credit. So it looks like almost everybody has responded. We have a few more coming in. I feel like we should have Jeopardy music playing when we launch these polls. Okay, so I'm going to close it out and share the responses. So it looks like overwhelmingly 69% of you said maybe, it's definitely a possibility, followed by no, what are you crazy? And then 14% of you said yes, of course they do.
All right, so you guys have already been studying up on GASB 87 because the answer is yes, maybe. So remember, going back to the definition of a lease, here we've got for a period of time in an exchange or exchange-like transaction. So a permanent easement would not meet the criteria of a lease due to having indefinite time. So if there's a lease for or some sort of contract for an indefinite period of time, then it's automatically excluded. But if an easement is not permanent, it would still need to be considered an exchange transaction to be considered a lease. So if there was, some $1 easement or something like that, that would be excluded as it wouldn't meet the exchange criteria. All right, moving on to the lessee reporting. So the initial measurement of the lease asset is going to include the lease liability, which we talked about previously, plus any prepayments prior to measuring the lease liability. It's also going to include any initial direct cost if they are ancillary charges to place the leased asset into service. Any lease incentives received should be reduction of the cost of the lease asset. Initial direct costs should be expensed if they are a cost other than charges to put the leased asset into use. All right, lessor reporting, initial recognition and measurement. So on the lessor side, we're going to recognize a lease receivable and deferred outflow of resources. One key here is you're not going to de-recognize the underlying asset that's being leased out. You're going to discount the lease receivable at the rate the lessor charges. The lease asset should continue to be depreciated unless it's required to be returned in its original or an enhanced condition, or the lease asset has an indefinite useful life. So if you're the lessor and you're leasing out land, then obviously you're not going to depreciate that. Initial measurement of the lease receivable is going to include any fixed payments to be made over the lease term, any variable payments that are made on an index or rate, any variable payments that are in substance fixed, or any residual value guarantees that are in substance fixed. So just some other considerations to think about as you guys are implementing 87. Various parts to a single contract. As you guys are probably aware, a lot of these contracts have different components to it. You are going to be required to go in there and break out the pieces of the contract that relate to the lease, and that there's potentially any service component to that contract. You're going to need to treat that separately from the lease. Ideally, you guys have already been kind of aware of GASB 87 coming down the pipeline, and maybe you've started to work with some of your vendors on getting your lease terms a little more structured, so that's a little easier to break out. Otherwise, you may have to use some judgment if there's not a specific breakdown of service components included in a contract. Any changes to a lease, if you've got a termination, you're going to write off the asset and the liability, potentially record any gain or loss for the difference. Any modification or change in significant circumstances, you're going to remeasure. You're going to change that prospectively, potentially remeasuring the asset as well. If you've got a sublease transaction, you're going to treat that completely separate as an independent transaction. And like we mentioned earlier, in the government world, sometimes it's pretty common to see those $1 land leases or something similar. Remember, it's got to meet the exchange criteria as part of the lease definition to be applicable under GASB 87. So some more considerations, some specific exemptions. If it's a lease with a transfer of ownership, That's going to be exempt from GASB 87, and you're going to use traditional capital lease accounting. Any leases of assets or investments, that's going to be excluded from GASB 87. Service contracts, we talked about that, that's going to be treated separately. Also, computer software licensing, that's been explicitly excluded under GASB 87 as well. As far as related parties, no changes from regular lease accounting under GASB 87. So if you've got any leases with related parties, there's not going to be any difference in reporting as far as the lease reporting under GASB 87, that is. Emphasis on substance of transaction, not form. Sale leaseback transactions, once again, you're going to treat those as independent transactions. The difference between the carrying value of a sold asset and the net proceeds from the sale is going to equal a deferred inflow or outflow, and it's going to be recognized over the term of the lease. Some specific accounting considerations. So the initial discounting of the lease payments. Once again, that's one you might want to start working with your lessors, or if you are a lessor, go ahead and start including or getting your lessor to include that rate within that contract. You're going to use the explicit or the implicit rate if it's available. If not, you can use the incremental borrowing rate. Ongoing impacts for the lease liability, you're going to amortize the discount as interest expense over time. Any payments that are received are going to be first applied to any accrued interest and then to reduction of the lease liability. On the asset side, you're going to amortize in a systematic and rational manner, i.e. straight line. I think that's the best way to do it. It's going to be the shorter term of the asset life or the lease liability. So some practical accounting considerations on the governmental fund financial statements. When the lease is initially recognized, you're going to have an expenditure and another financing source revenue in the period of the initial recognition. Materiality, there is no official de minimis threshold established by GASB 87. However, we are recommending that you, considering your organization setting your own policy, similar to what a capitalization policy would be, really what you're looking for here is you want to be recording any material leases. However, if you've identified a certain threshold that would be immaterial to your organization, then it may be worth not including those under the scope of GASB 87 since it wouldn't be material. So looking at note disclosures a little bit, you are required to include a general description of the leasing activities, highlighting any significant items that are used in determining the liability itself. You are required to disclose a total amount of the lease assets, gross, accumulated amortization, and net. Separate from other capital assets. Now you could include it within the capital asset note, but you do want to make sure it has its own line item. The amount of lease assets by major classification. Current year outflows for variable payments that are not included in the lease liability. Principal and interest payments in a 5-year format. I think we're all pretty familiar with that one. Components of any loss with impairment if there was such transaction during the year. And then if you did have any sublease or sale leasebacks transactions, those would need to be disclosed separately. All right, so that brings us to polling question number 3. So a contract allows the vendor to replace an asset with an identical asset. Does this affect the control of the right to use?
Okay, so we have about 75% of you who have voted or who have responded. Excuse me. So we'll leave it up for a couple more seconds before we close the poll. Okay. All right. I am going to go ahead and close the poll. If you missed it, don't hesitate to leave the response in the Q&A. And let's share the results. So 42% of you said no, it doesn't. 40% maybe, it's definitely a possibility. And 18% yes, it really does.
Okay, so most of you guys got this one right as well. So no, the ability to substitute an essentially identical asset is not going to disrupt that control criteria. So you're still going to have a lease agreement here, and then it's still going to fall underneath GASB 87. All right, so moving into some of the visual refreshers. First, we're going to start with initial reporting. So on the lessee side, as far as the asset goes, the lessee is going to recognize an intangible asset for the right to use the underlying asset, and it's going to be the value of the lease liability plus any of those prepayments that were made in advance or any initial direct costs that were used to get the asset placed in service. Sticking with the lessee side, they're also going to recognize a liability for the present value of future lease payments, and we're going to include all those items that we went over on the previous slides. On the lessor side, looking at assets, the lessor is going to recognize a lease receivable, which is generally including the same items that are included in the lease liability. Once again, the lessor is going to continue to report the leased asset. They're not going to recognize anything on the liability side for the lessor, but they are going to recognize a deferred inflow, which is going to be equal to the lease receivable plus any of that cash that was received up front that's related to a prepayment of a lease. So visual refresher, here we're going to go into like a specific example. Basic facts and circumstances, we've got a road equipment lease. The term of this lease is going to be a non-cancelable 60 months with an option to extend 24 months. Based on the judgment, we've determined that it's not likely that that option is going to be extended. The payment is going to be a base payment of $1,000 a month. That base payment includes 200 hours of use per month on this equipment lease. And then it's going to be $5 additional required for every additional hour used. We're going to estimate that we're going to use 300 hours per month of this piece of equipment. In addition, there's a set $80 a month payment for repairs and maintenance. Stated in this contract, we've got a 4% rate. Some additional charges we've got here, we've got an $800 charge for delivery and a $700 charge for installation. All right, so what is relevant to recording this lease? First of all, look at the lease term. We're only going to include 60 months since it's not reasonably certain the option is going to be extended. Initial measurement of the lease liability, we're going to include the sum of all the base payments discounted at 4%, comes out to $54,480. As far as the excess use charge for additional hours, that's going to be excluded. Remember, any use charges related to a lease asset, that's not going to be included as part of the lease liability. Repairs and maintenance, that's going to be excluded as well. Remember, we're going to exclude any service components to a contract. The lease asset is going to include the amounts above plus the delivery and installation fee of $1,500. So here we've got an example where the lease asset and liability are not equal to each other, and the difference is that delivery and installation cost. So here, looking at the T-charts with the debits and credits, on the lessee side, we've got the cash paid $1,500 for the delivery and installation. You've got your lease asset, the $55,980, which includes both the lease liability plus the delivery and installation charges to get the asset ready for use. On the lessor side, we've got the cash received for the delivery and installation. We've got a lease receivable equal to the deferred outflow, which is the present value of all the future lease payments. And then there's also some revenue recognized for the installation charges. So ongoing reporting, what happens after that initial recognition of the lease? On the lessee side, For the asset, they're going to amortize the intangible asset. That's going to be over the shorter of the useful life or the lease term. On the liability side, we're going to reduce the lease liability as payments are made, less any amounts that's actually being categorized as interest. On the lessor side, looking at the, back up, Stacy, thank you. Looking at the lessor side under assets, we're going to continue to depreciate the leased asset unless it was something with an indefinite useful life, such as land, or it was required by the contract to be returned in its original condition. We're going to reduce the receivable by the lease payments received, less any amounts that are being applied to accrued interest. We're also going to recognize revenue over the lease term and reduce our deferred inflow in a systematic and rational manner. So here's what it looks like on the T-charts, the debits and credits. So as those payments are received on the lessee side, you see there's the reduction in cash with the payment, and then it's offset against both the lease liability and interest expense. The lease asset is then reduced and amortization expense is recognized. On the lessor side, you see they've got the increase in cash for the $1,000 payment received. The lease receivable and the deferred inflow are reduced by the $822, which is the lease payment less any amounts recognized as interest revenue. So some other considerations with implementation. So looking at your, looking at your current bond and debt covenants, what is this going to do to your balance sheet? What's it going to look like? How's it going to affect your debt covenants? So something to probably go ahead and start thinking about now. If you recognize there's going to be any issues potentially with your covenants, probably go ahead and start reaching out to your lenders now. In our experience, most of them are aware that this is coming down the pipeline, so shouldn't really be any surprises there. Consider setting some internal policies regarding leases, working capitalization threshold. So even though there isn't a specific de minimis threshold, really look at what makes sense for your organization as far as materiality. Probably look at implementing a policy which defines reasonably certain. As we talked about before, especially with the lease term, there is some judgment involved. So having a standard way of looking at that, so you're not, changing, and you want to be consistent as how you're applying that reasonably certain definition. Any allocation procedures for non-lease components, probably establishing some procedures on how you're going to allocate any service components of contracts that aren't broken out separately. And then making sure you're separating this information from your other capital assets, as it does have some different reporting requirements. If you haven't already, kind of a good starting point is going ahead and summarizing the leases that you have now, summarizing the terms, so then when it comes time to implement, you'll have the information available. Some great starting points, your current operating lease note disclosures, or potentially your rent expense general ledger accounts. All right, so now we're going to jump into the implementation guide itself. As we mentioned before, the implementation guide that came out has quite a few questions that are really good. It's honestly one of my go-tos whenever either I've got a question about GASB 87 or I've got a client who asked me about it. There are quite a few questions that have been answered already in the implementation guide. So it is a really good resource. There it is. It actually has 77 questions overall. There are also 3 illustrations. One of them is pretty similar to the one we just went over, where there's a reporting of an equipment lease. There's also an example with a lessee reporting of a building lease that also includes lease incentives. And there's also an example with variable payments that are dependent on an index or rate. So jumping into some of the questions that I think are some of the most helpful or applicable. So a government enters into a multi-year agreement for the right to use a facility. The government has exclusive use of the facility 3 days a week. Other parties use the facility on the other days. To meet the definition of a lease, is the government required to have uninterrupted control of the right to use the facility? So this is one that I may have referred to back at the beginning of the presentation. The answer here is no. So per GASB 87, the contract must convey the right to determine the nature and the manner of the use of the underlying asset as specified in the contract. So as long as the government has the ability to determine the nature and manner of the use as specified during the contract, whether that's Monday, Wednesday, Friday, or that's every day of the week, then it does meet the definition of a lease. So 4.4, a government enters into an agreement that allows a rancher to use the government's land for grazing. The agreement states that the rancher is required to allow access to the land for compatible public recreational activities. In addition, the agreement states that the government can construct roads and buildings and otherwise alter the land without permission from the rancher. Do the grazing rights agreement meet the definition of a lease? So the answer here is no, it does not meet the definition of a lease because the rancher does not have the ability to determine the nature and the manner of the use for the land, as the rancher cannot prevent others from accessing the land, and the government has the ability to construct on it without the rancher's permission. So this is a pretty common question. Are cell phone tower or antenna replacement agreements leases? So pretty straightforward question. The answer they have isn't quite as straightforward as this one is more of a maybe. Once again, we're going back here to the definition of a lease. If the contract meets the definition of a lease, then yes, you'd be required to report it under GASB 87. If it doesn't, then no. So remember, we're looking at that control criteria and also the exchange criteria. If it meets both of those, then yes, it would be a lease. A developer builds and leases a building to a government. The government is required to make payments during the 3-year construction period. The government does not have access to the building until the CO is issued at the end of the construction period. When does the lease term actually begin? So the lease term is actually going to begin when that CO is actually issued and when the government has access to that building, when they take over that, when they're able to meet that use criteria. So remember, as we talked about before, any prepayments that are made are going to be counted as part of the lease asset. A lease contract allows either party to unilaterally terminate the lease at any time, but also provides for cancellation penalties. The cancellation penalties are so great that it's reasonably certain that neither party will terminate the lease. Should the cancelable periods be excluded from the lease term? So yes, remember that periods for which both parties, the lessee or the lessor, have an option to terminate the lease without permission from the other party are going to be excluded from the lease. A lease contract allows only the lessee to unilaterally terminate the lease at any time, but also provides for cancellation penalties. The cancellation penalties are so great that it's reasonably certain that the lessee will not terminate the lease. Should the cancelable periods be excluded from the lease term? So no, periods covered by either a lessee or a lessor option to terminate should be excluded from the lease term if it's reasonably certain they will not be exercised. So here in this situation, we've got a lessee only option to terminate, and the option to terminate is reasonably certain not to be exercised. So since it's reasonably certain not to be exercised, the answer here is no. A government enters into a 12-month lease with the lessee having the option to renew for 12 months at a time, up to 49 times. Is this agreement a short-term lease under GASB 87? And remember, short-term leases would be essentially excluded from GASB 87. So the answer here is no. Since the maximum possible term is greater than 12 months, we're not going to factor in you know, if it's likely that it's going to be extended or not. If the maximum possible term is greater than 12 months, then it's not excluded from GASB 87. So government adopts a capitalization threshold and expenses acquisitions, including lease assets that fall below the threshold. Can the government apply a similar threshold to recording lease liabilities? So that's one we've talked about again. According to GASB, there is no specific de minimis threshold. However, we are recommending that your entity, you guys look at what's going to be material for your organization, and ultimately setting a policy. And if it's not material, then you know, there's no reason that you couldn't exclude it, exclude the recording under GASB 87. A government leases a fleet of vehicles for half of the vehicle's estimated useful life. The lease term is 30 months. The lease does not specify a discount rate. The total monthly lease payments over the term of the lease are $1.1 million, and the fair value of the vehicles at the commencement of the lease is $2 million. May the fair value of the vehicles be used in determining the implicit discount rate of the lease. So yes, if you do know the fair value of the assets that are being leased and the lessor does not explicitly state an interest rate, you can use the fair value of the vehicles to back into what that implicit rate is. Can amortization expense for lease assets be combined with depreciation expense in the required disclosures by function? So pretty straightforward answer here. The answer is yes. You can combine the lease amortization expense with depreciation expense within the disclosures. Should lease assets be included in the disclosure of changes in capital assets? I think we touched on this one a little bit earlier, but yes, leases are going to be considered capital assets, and they should be included within the changes in capital assets note disclosure. Can methodologies other than the interest method, such as straight line amortization, be used to amortize the discount on the lease receivable? So here the answer is no. Lease receivables should be amortized using the interest method. So you are going to have to generate amortization schedules for any of the lease receivables you have. A government leases one floor of an office building to a private party for several years. In the middle of the lease, there's a significant downturn in the local real estate market. The government and the lessee renegotiate the rental payments for the remainder of the lease. The lease receivable, which is the present value of the lease payments expected to be received during the remaining lease term, before the amendment was $500,000 and after it was $270,000. How should the government account for the lease modification? So remember, we're going to remeasure prospectively. In this situation, it's going to be a remeasurement of the lease receivable and also the deferred inflow. In this situation, the government's the lessor, so the receivable and the deferred inflow are just going to be reduced to the same amounts of $230,000. All right, so where to find more information on GASB 87? I put a link in here to the full text as well as the summary. Down at the bottom, there's a link to the implementation guide in which a lot of the questions we just went over came from. So our next webinar is going to be June 16th at 2 p.m. It's on Excel, so it's a little more detailed information on some of those Excel functions. There's a link at the bottom to register now. We do have a few minutes for some questions. If you guys have any questions, I believe there's a chat box that Stacy has access to.
Yes, so we did have a handful of questions come in. I'm not sure if we'll have time to answer all of them, but I'm just going to start at the top and we'll work our way down. And for those of you who submit a question, if we don't have time to answer them, either Anthony or Wayne will follow up with you after the presentation. So the first question, which I think will be directed to you, Anthony, when a third party essentially prepays for services on behalf of the individual who will receive our services, are those funds considered own source revenues even though the revenue is not yet earned? As an example, scholarships received from a third party for an entire year of tuition upfront.
Well, I would think the scholarship example there would sort of answer that question, because that's a voluntary non-exchange transaction. Beyond that, it's then for the individuals, and then you'd have to determine the administrative implications of that. So it depends. You'd have to look at the agreements and stuff probably a little more, but I would lean towards that no, it wouldn't be a fiduciary.
Okay. And the second question that came in, if a primary government has a 403B plan that no longer provides contributions to the plan, will that be considered a fiduciary fund? The plan is expected to be terminated soon as there are no longer employees of the primary government.
That's probably one that would be better for us to circle back to, I think, and reach out and discuss. I think there's probably more there than a straightforward answer.
Sure. Okay, the next question, how do we record existing leases? Based on the remaining time value of the lease, or will this only apply to new leases?
So you are gonna implement as of where you're at now is in the lease. It's not going to be something you're going to implement going forward. So you are going to have to measure your lease assets, liabilities, etc., based on where you are at the date of implementation.
Okay. If a lease is for $1, which is not an economic lease, then it may need to be recorded under GASB 33. Is that correct?
I believe that's going to be excluded completely from lease accounting, as it doesn't meet that exchange criteria. So I think for the purposes of lease accounting, it's going to be completely excluded.
Okay. What is the best way to find the explicit implicit rate, or how do you determine the incremental borrowing rate?
So the best way to do it would be to have your lessor, or if you are a lessor, start actually including that rate within the contract. If it's not in there, we did cover an example where if you knew the fair value of the assets being leased, you could back into what that implicit rate is based on the payments and things like that. However, if you're looking at your incremental borrowing rate, possibly looking at what kind of interest rate you would get if you were to buy that similar type asset or and get that asset financed. But like I said, the best way to do it is to actually have have the lessor start putting that information in the contracts.
Okay. For airport leases that are regulated by the FAA, how are those recorded and presented?
Airport leases that are regulated by the FAA, I think everything, it's going to fall under what we just talked about under GASB 87. I don't expect any differences or any industry specific issues related to lease recording.
Okay. And how would you handle a cell phone tower lease that has renewal periods beyond the estimated useful life of the tower and total payments that exceed the fair market value of the tower?
So it sounds like it still meets the definition of a lease based on what we talked about earlier. However, if you remember, we looked at what the lease asset's going to be amortized over the shorter of the lease or the asset's useful life or the term of the lease. So if the term or if the useful life of the lease asset is shorter than the contract, then you're going to amortize that asset by that shorter useful life.
Okay. And then our last question that came in was really just with regards to the polling question. So were there only 3 polling questions so far? And yes, we only had 3 polling questions during the presentation, so you likely did not miss any. And we did get a comment about how there were no dad jokes for this webinar, which we didn't put those together. So we do have a few more minutes. If anybody has any additional questions, don't hesitate to put them through. And I think that might be it. So here's contact information for Anthony and Wayne. If you have any questions regarding the implementation of GASB 84 or 87, please don't hesitate to reach out to them. They'd be more than happy to help you. And just as a reminder, we do have 3 more webinars in our government CPE series. We're taking a break the end of June and into July, the 4th of the July holiday, and we'll resume on July 14th. So thank you all so much for joining us today. Wayne and Anthony, I appreciate you taking the time to walk us through GASB 84 and GASB 87, and we hope you all stay safe and healthy, and we look forward to seeing you next week. Have a good day.